ever stopped and wondered what really moves the global financial markets these days? I mean, it's not just people in suits on a trading floor anymore, not by a long shot. Silently, a revolution has taken over, and it's all powered by artificial intelligence. So today, we're going to crack open the black box of algorithmic trading and see what makes the AI that moves trillions of our dollars every single day tick. And just to give you a sense of the sheer scale we're dealing with, look at this number. A 2019 study found that something like 92% of all trades in the massive Forex market, that's the foreign currency exchange, were done by algorithms, not people. 92%. That's basically the entire market. And this isn't even a new thing. All the way back in 2011, the CEO of NASDAQ, Robert Greifeld, he put it pretty bluntly. He said, "It is over." That quote just perfectly captures this huge, permanent shift away from human gut feelings to these automated, lightning-fast systems. The old way is gone. Okay, so that brings us to the big questions for today. How in the world do these algorithms actually work? What is going on inside these digital brains? And maybe the most important question of all, what does their total dominance mean for the future, for the fairness and stability of our entire economy? To really get where we are now, we have to look back at how we got here. The journey from simple, pre-programmed rules to these intelligent trading robots, well, it didn't just happen overnight. It's been a slow burn, an evolution of tech and regulation that's been decades in the making. Right, so the road to today's automated markets was paved one little piece at a time. It started out pretty simple in the 70s with just getting orders onto a screen. Then, by the 80s, computers started bundling those orders into what they called program trading. But the real game changers, they came in the 2000s. First, a switch to decimal pricing totally squeezed the profit margins, which meant you had to trade in massive volumes at high speed to make money. And then, in 2005, the regulators basically made electronic trading mandatory. And with that, the floodgates just burst wide open for full automation. And here's the crucial thing to remember about these early bots. They weren't thinking. Not at all. They were just incredibly fast rule followers. A programmer would give it a simple instruction, something like, hey, if this stock's 50-day moving average crosses above its 200-day moving average, buy it. That's it. The bot wasn't smart. It was just executing that command way, way faster than any human possibly could. But that was then. Today's trading algorithms have evolved so far beyond those simple rule-based systems. Now we're talking about really sophisticated AI models that can learn, they can adapt, and they can make decisions all on their own. Yeah, these modern systems have all different kinds of brains, each one using a unique AI approach to try and outsmart the market. The competition isn't just about being the fastest anymore. It's about being the smartest. So one type of AI brain, you can think of it as an eavesdropper. It's constantly scanning the internet, social media, news articles, forums like Reddit, and it's analyzing human emotion. It's literally trying to read the mood of the crowd and turn that into a trading signal, turning all that online chatter into actual buys and sells. So how does it pull that off? Well, it uses a technology called natural language processing, or NLP, and that's basically just teaching a computer to read and understand human language. It scans millions of posts, figures out if they're positive, negative, or neutral, and assigns a sentiment score. So a sudden wave of positive feeling online might trigger a buy order, while a flood of negativity could trigger a sell. Okay, then there's a completely different kind of brain, one that learns just like a pro gamer. This approach is called reinforcement learning. They basically drop an AI agent into a simulated market and tell it, go make trades. When it makes a profitable trade, it gets a reward. When it loses money, it gets a penalty. And after millions and millions of these trial and error runs, it teaches itself a winning strategy to get the biggest reward possible, aka profit, all without a human writing a single rule. And this is the real cutting edge. Researchers are now using the same kind of AI that powers stuff like ChatGPT to predict the market. Just take a look at these charts. The AI's prediction is in orange, and it's laid right over the actual chaotic price of Ethereum in blue. Look how closely those two lines track each other. The AI is learning to see patterns in the chaos with startling accuracy. And what's really wild is that this kind of power isn't locked away in some Wall Street hedge fund anymore. Using public, open-source tools, pretty much anyone can now pull in live market data, plug it into a free AI model, and tell it to start trading. The barrier to entry for creating your own basic trading bot, it's basically crumbled. Okay, so we've seen how these algorithms think. But what happens when you unleash these super fast, super intelligent systems onto the real world market? This is where we get into the major consequences: the good, the bad, and the genuinely scary. So, first, let's talk about speed. High frequency trading, or HFT, is a special brand of algorithmic trading that operates at speeds that are just impossible for our brains to comprehend. We're talking microseconds. And this isn't some niche strategy. Today, HFT firms are responsible for over half of all stock trading volume in the entire United States. Their total dominance brings up a pretty terrifying question. With so much of the market controlled by these autonomous systems making decisions in the literal blink of an eye, what happens when the bots go wrong? Well, on May 6, 2010, the market got its answer. It's now known as the flash crash. In just a few minutes, the Dow Jones Industrial Average absolutely plummeted, losing nearly 1,000 points. And then it mysteriously bounced right back. That total swing in one day was over 1,010 points, one of the biggest in history. So what on earth happened? Well, it turns out that a single, very large sell order placed by an algorithm started a domino effect. High-frequency trading bots saw that sudden drop and reacted instantly by just yanking all of their own buy orders out of the market. This created this terrifying feedback loop where the selling just caused more selling, which caused even more selling, accelerating the crash. It was a massive wake-up call about the new kind of risk that's baked right into our automated markets. And this really gets to the heart of the big debate around algorithmic trading. On one hand, supporters will tell you it's a good thing, that these bots provide liquidity that makes trading easier and cheaper for all of us. But on the other hand, critics are warning that we're basically in a high-tech arms race, creating a system that's fragile, easy to manipulate, and can create terrifying crashes out of thin air, just like we saw in 2010. So, where does all this leave us? Well, like it or not, we are hurtling towards a future where the line between human and machine decisions in the world of finance is getting blurrier and blurrier every day. In fact, one scholar captured this new reality perfectly. They called it cyborg finance. I love that term because it's not just about humans using tools anymore. It's a true hybrid system where people and machines are co-pilots and sometimes even rivals in steering the entire global economy. And that, of course, leaves us with the final and maybe the most important question of all. As these incredibly complex algorithms take on more and more of the world's financial decision-making, operating at speeds we can't even comprehend, you have to ask yourself, who or what is really in control here?